Hi, everybody. Scott Riley, the Market Update Desk and Mortgage One. Well, we've got January 17th here, getting halfway through the week. We still have a lot of commentary, information coming out of Davos World Economic Forum, and that's really what's driving a lot of the market volatility today and yesterday, and through the end of the week going into next week. The big number that came out today that people were looking for was December retail sales. What was it going to show? Did the consumer slow down? Did they expand? Has the consumer tightened their belt even more? So that's what everybody's waiting for. And it did indicate strong consumer demand at the holidays. Retail sales, in fact, grew 6/10 in December, and that was above analyst expectations of 4/10. Now, excluding auto sales, that rose 4/10 also, which was also above the top end estimate of 0.2%. So the consumer still came out to play in December, and that is a little bit challenging to the market right now. It has taken the 10-year bond upwards, closing in on 4.10. So we have had a decent sized increase in the 10-year bond and a decrease in mortgage-backed securities over the last week. Seen a little bit run up on interest rates, probably 0.25% or so. So we're having some pressure on both ends of that spectrum this week. Now, we also talked about all the Fed speakers that were going to be this week. In fact, Fed Governor Waller came out and suggested that while the central bank will likely cut rates this year, he quoted, "It may take time." That's not necessarily what the market was looking for. They were looking for reinforcement of the March timetable and 6 rate cuts for this year. And the market's not quite hearing what it wants to from all the Fed members this week. So we're going to see how this all goes. The president of the Dutch central bank, Klaas Knot, told CNBC Wednesday that the Eurozone's central bank looked at overall financial conditions and felt that more easing the market has already done for us, the less likely we will cut rates. What he's referring to is the fact that higher stock and bond prices in the fourth quarter of last year acted as the equivalent of easier interest rate policy, while lowered prices act as the equivalent of tighter fiscal policy. Goldman Sachs CEO David Solomon said Wednesday at Davos that while the market environment, excluding geopolitical issues, feels better today than a year ago, he still is troubled by soaring U.S. debt levels, which we've covered countless times here on this newscast. It's a big risk issue that we're going to have to deal with and reckon with. It might not happen in the next 6 months, but we're going to have to address the deficit and spending. JP Morgan CEO Jamie Dimon said he remains cautious of the on the U.S. economy over the next 2 years because of the combination financial and geopolitical risks. So there is still some concern, caution there. Wall Street has earnings week upon us again. Seems that creeps up on us every time earnings season, and that starts out with the big banks and investment banks this week. A lot of those are going to be Chase, Goldman Sachs, BlackRock, Citi. The big boys are out this week, and that'll drive a lot of the movement for the rest of the week. Now, this all leads up to next week being CPI inflation week, so we're kind of on a big pause, having movement within the market based on Fed comments. Tomorrow we get jobless claims, more Fed comments, more commentary from Davos as it goes through the week. So we're hoping that we kind of get a ceiling on this increase we've been seeing so that we can get into next week with potentially some better economic true data versus commentary coming out. We thank you for watching this as always. Do us a favor, like, share, comment on these posts. Follow us on Facebook, Instagram, and YouTube, the Market Update Desk. If you have any questions, need to get pre-approved, give us a call, 616-293-2189. We're here available for you. Take care.